Good morning, and welcome to this EPC policy briefing, where we are going to hear about the macroeconomic outlook for Europe. Very glad to have Dr. Oscar Arce here, who's the General Director Economics in the ECB. Welcome to all of you. This is a hybrid event, so we have people in the room, but also people online, and I'm hoping we'll have good participation from all of you, including for the question and answers. I think this is a very interesting moment to look at where we are at in the euro area in particular, with inflation rather higher than we would have wanted, rather higher than the target which we have. And there's the question of how can inflation be brought back under control? Of course, taking into account the macroeconomic situation we're finding ourselves in, and in particular, the rising cost of energy and the implications of the war of aggression Russia is fighting in Ukraine. We've also seen a lot of turbulence on the currency markets, including depreciation by the euro against the dollar. We've seen a lot of turbulence also in our near neighborhood, with the UK being very much in the focus in the last few days. I think the question really of how do you manage an economy, how do you manage as a central bank in these kind of times is one which is extremely difficult to answer, but will have to be answered, because the much broader context in which we are in is that we are heading into whatever you want to call it, a winter of discontent, a winter of severe economic difficulty with high inflation, high cost of living, recessions, very much pressure on fiscal systems, pressure on financial systems. But we will have to deal with these issues, because in the end, this is a war which is also fought against us, and we will have to deal with the consequences of that. So I think this is a very important moment to take stock, to see where we are, what the expectations are, and I would hope that in the Q&A we can then also focus on some of the detail of that and try to tease out a bit more where also the risks lie. Maybe some upward risks as well as downward risks, although the situation, of course, is extremely difficult. So we will hear first from Oscar with a presentation of the main trends, and then we'll go into a question and answer session. For those in the room, we can give you a microphone and have your questions directly. If you're online, please feel free to put a question in the question and answer section, and I will pick those up in the discussion. So without further ado, Oscar, thank you very much for coming, and looking forward to your presentation.
Thank you very much, Fabian, and thanks to the EPC for this kind invitation, and thanks to all of you for joining us today. As Fabian said, my job here today is going to consist of presenting the main aspects of our macroeconomic assessment, our assessment on the macro and inflation outlook, and I will pay some special attention to the recent forecast exercise that was produced by the ECB staff a few weeks ago. So let me go through the main elements of my talk. I will refer to the current euro area economic environment. As you all know, this is very much conditioned by what is going on in the energy markets, and in particular is very much conditioned by the current gas disruptions, especially following recent decisions by Russia. An important element in our analysis, as Fabian mentioned, is the depreciation of the euro exchange rate, which is also likely to play some role. And another important element that play a role in our internal discussions in preparation for the forecast has to be also with the ongoing tightening of financing conditions, which essentially reflect both a reassessment of risk in the capital markets, but also the impact of the ongoing monetary policy normalization, which is carried out by most major central banks, as you know. An important element of our narrative, of our analysis as well, has to do with the so-called supply bottlenecks, which, here we have one of the very few positive developments, as we see that some of these supply constraints are easing. On the other hand, however, we are also seeing some evidence telling us that the reopening effects that were pushing up demand for services are probably losing some steam. No? And this is going to imply a certain slowdown in aggregate demand in the quarters to come. An important element of the discussion these days, of course, has to do with the additional fiscal measures that many European governments are adopting these days in order to cushion the negative impact of the energy crisis on income and prices. And of course, I will devote some time, it cannot be other way, to discuss about recent inflationary developments. So later on, I will go briefly through the main elements of our September ECB staff macroeconomic projection exercise, which, the main headlines of this exercise is that we introduced a significant downward revision on GDP growth over the whole horizon, 2022-2024, and an upward revision on the inflation profile, especially also in 23. So, given these new projections, now we expect inflation at the end of the horizon projection in 2024 to stay on average at 2.3%, which is clearly above our 2% medium-term inflation target. And as Fabian mentioned, we typically also conduct risk analysis around the central scenario. In this case, the Governing Council, in its meeting in September, judged that risk surrounding the growth path are clearly tilted toward the downside. There are some upsides, but in net terms, we are more worried about those on the downside, mainly related to the energy crisis. And unfortunately, risk on inflation remain predominantly on the upside. And then in the final part of my talk, I will refer briefly to the most recent decisions made by the Governing Council in the field of monetary policy. So let me go quickly through some of the key elements that play some special role these days in our macroeconomic analysis and in our projections exercise. Of course, one important key issue these days is the evolution of some key commodity prices. Here on the left chart of this slide, I'm showing the evolution of the prices of oil, gas, metals, and food. First important message, uncertainty and volatility on these prices is huge. It's at historically high levels. No? When we completed our projection exercise in September with a cutoff date at the end of August, we incorporated a very significant increase in the price of gas with respect to our previous macro projection exercise in June, which is the big positive yellow bar in the central panel there. At the same time, we incorporated somewhat more moderate levels of the prices for oil, metals, and food. And since we closed this exercise, that is over the last 4 weeks maybe, what we have seen is a further moderation in the price of oil in particular and metals, but also we have seen also some downward correction in the price of gas. So a lot of volatility on these key prices, and what we are seeing now, putting things together, is probably a lower level of these prices, which if maintained should help to ease some of the ongoing inflationary pressures. But volatility and uncertainty is huge around this. Now, exchange rate on the chart on the right side. Already in September, we incorporated a sizable depreciation of the euro exchange rate, especially vis-a-vis the US dollar. And since then, what we have seen is a further mild depreciation of the euro vis-a-vis the dollar. So, I mean, as you know, the ECB does not target the exchange rate at all. It's not a target for us, but of course, it's an important macro-financial variable that we monitor very closely because it affects our economic and inflation outlook. So, recent data on activity. Well, the signals for both the manufacturing and the services sectors lately are not particularly positive. Here I'm showing on the left the evolution of the PMI indicators, and in both cases, the signal is that the euro area economy is probably already in the course of a strong deceleration, a slowdown. Okay, with both manufacturing and services indicators already placing in a contractionary territory according to this index. Now, as I said before, a positive, one of the few positive signals these days come from the several metrics of the strength of these so-called bottlenecks. Here on the right, I'm showing the evolution of one of these metrics, which is the suppliers' delivery times according to market as well. And what we are seeing recently is a significant reduction in this average delivery times, no? Which is, I mean, the obvious interpretation is that some of these frictions that were limiting the normal functioning of international trade and global value chains and so on are in the course of being resolved. Okay, so this is of course positive, particularly for the manufacturing sector. Another important element that plays a central role these days in our forecast exercise, of course, has to do with financing conditions and in particular with the evolution of interest rates. I mean, in our last exercise in September, we already incorporated a significantly higher path for interest rates, both in the long term, as seen in the right chart, and especially in the short term. And there you can see the very significant change in the level of these two curves of the short-term and long-term interest rates in a question of just a few months. I mean, in March this year, that is 6 months ago, we were in a situation depicted here by the yellow lines, which were significantly lower in terms of the levels of the interest rates, both in the short and in the long term. And now we are up. I mean, today we are above the blue line here, no? which is the one that was considered in the September exercise. So this is, I mean, sometimes people say, well, you are really now starting the normalization of your monetary policy. Well, this is not true. Normalization started already in December last year, and it was well reflected in the evolution of financing conditions and, of course, in interest rates, which have been on the rise significantly over the last few quarters. And of course, we incorporate this information in our forecast. So, as I said before, an important also aspect in the current juncture has to do with all the measures that are being announced and implemented by many European governments in order to cushion the negative impact of the crisis on income, activity, and prices. Our technical staff have estimated that the overall volume of those measures implemented in an attempt to try to counteract the negative impact of the energy crisis amount to around 1 percentage point of the euro area GDP. This does not include the recent announcements by some governments. This is the information that was available at the beginning of September. So this magnitude is probably going up as we see more and more announcements by several governments. And we estimate that this is going to have a positive impact on GDP already this year in the order of magnitude of 0.5 percentage point more than in the absence of these measures. And it's going to have some relief effect on inflation that we estimate in the order of magnitude of 0.7 percentage points lower inflation this year as a consequence of all these measures. We keep updating, of course, this information, and in the December exercise, we will include all this new battery of measures that are being announced these days. So one element that could play a role also in buffering the negative impact of the energy crisis on the demand, activity, and eventually employment is the accumulation of savings during the worst part of the pandemic by the households. So there is, I mean, we have estimated a significant increase in the overall volume of savings during the pandemic, and this should help to cushion the negative impact of higher energy prices on real purchasing power of households. However, with two important question marks here. One has to do with the fact that the accumulation of savings has been, for sure, very heterogeneous across different households. I mean, we have some micro evidence telling us that most of the savings accumulated during that period were in the hands of those households with higher income levels. And we know that these households typically have a relatively lower propensity to consume. So yes, savings are there. Yes, savings can help cushion the negative impact of the crisis, but the distribution is probably uneven. I mean, not every household, of course, can rely on this pocket of savings to cushion the fall in real incomes. Another important element of caution here is that as the macroeconomic situation gets more and more uncertain, we are detecting some rise in savings, recent rise in savings for precautionary motives. So those households that have capacity to save, in face of this rise in uncertainty, are starting to save again. So this may somehow reduce the power of this lever to support consumption in the coming months and quarters. So another maybe the most relevant, let's call it bright spot in the euro area economy is probably the labor market. Employment remains quite strong, and this is true for all sectors. As you can see here in the chart on the left, employment has recovered in a rather sustainable manner since the pandemic. In terms of total persons, the total number of employed persons, we are clearly above the pre-COVID levels, and this is true for the industry and for the services, and of course for the public sector. The public sector increased quite significantly the volume of employment at the beginning of the pandemic, and it has maintained it at a relatively high level. No? But employment is quite strong for the time being, and this has allowed for some further reductions in the level of unemployment. In July, which is the latest figure for the unemployment rate in the euro area was at 6.6%, which is the lowest level ever. Nonetheless, we are already detecting some signals of a potential weakening in employment. No? And the information that I'm showing here on the right panel, coming from the PMA survey, is telling us that employment is probably starting to decelerate, okay, in the euro area. It's still in an expansionary phase. I mean, the indicator is still above 50, which means that employment is still growing, but with some signs of moderation, no? In particular in some sectors like the construction sector here. I mean, this green line corresponds to employment in the construction sector and is already in negative terrain. So employment remains strong, but we cannot rule out the possibility that it will somewhat moderate in the coming quarters. For inflation, by the way, we will learn the figure for September, the flash indicator for September in just a few minutes. The latest data we have is the one corresponding to August. Inflation in August was at 9.1% for the whole euro area. It is still the case that half of it comes from essentially from energy. As you can see on the left panel, this red bars corresponds to the energy component. Half of the rise in prices, a little bit less, but a significant part of it corresponds to energy inflation. Now, with an increasing and worrisome rise in prices in food as well, which is the green line here. I mean, you can see that the contribution of food prices in the acceleration of overall inflation is on the rise, and this is, of course, for many considerations, is a particularly worrisome signal. So, in terms of energy inflation, I mean, here I focus on the main components of the inflation of the energy inflation. I mean, for most part of this period, the main component behind the acceleration of energy prices was fuel. Okay, and this was due not only to the increase in oil prices, but it was also due to the fact that there were some base effects, reflecting with some delay the volatility of oil prices during the pandemic. Now, it is true that the electricity and gas components have gained relevance in the overall energy index, and now gas is playing a significant role, no, in explaining this evolution of the overall energy price. We should expect, we expect nonetheless some. Of course, this depends very much on whether we will face some potential new shocks on the main energy markets. But in principle, we should expect, and I will refer to this later on when discussing the information coming from the future markets. No? But in principle, we should expect some moderating impact from oil prices and fuel prices, among other things, because there is, from March onwards, there will be a negative base effect on the contribution of the oil price to the energy component. But again, uncertainty is quite high, and unfortunately, we cannot rule out more positive surprises, adverse surprises on inflation. Now, on core inflation is also on the rise. It's above 4% in the euro area. All the components in the core basket are clearly on the rise, as you can see on the left panel here. Still, I would like to focus on two specific components, the two most relevant ones, which are those depicted here through the yellow bars and the purple bars. So you see, look at these yellow bars. This corresponds to the inflation coming from recreation services. They have contributed quite importantly to inflation, especially in the recent period, as a consequence of the reopening of many of these activities following the phase out of some of the restrictive measures that were introduced in the context of the pandemic. So, in principle, we should expect some moderation coming from this inflationary component as the demand for these services slows down in the coming months. But still, the inertia there could be considerable. And the other component that is playing a role in core inflation is the prices of durable goods, the purple bars here. And again, here I think this high contribution in terms of inflation coming from this category of goods obeys to the combination of two specific factors. First of all, there was an accumulation of demand that was not satisfied during the pandemic because it was not possible to purchase certain goods. So we tend to think that there was an important element of pent-up demand there that was only satisfied after the pandemic or the worst part of the pandemic. So an important surge in demand for these goods, but also the production of these goods has been affected negatively by the bottlenecks in the industry. So both higher demand and lower supply would have contributed decisively to increase the prices of these durable goods. So again, looking forward, these things typically have a lot of inertia, of course, but we should expect some moderation, no, on account of the improvement in the conditions of the supply, the improvement in the bottlenecks, and also we should expect that this pent-up demand fades away at some point. But again, we know that there is also typically a lot of inertia, and pipeline pressures are still very, very high. So most measures, other measures of core inflation, other measures that we use to gauge the intensity of price pressures on the more stable components of the consumption basket are sending us the same signal. Core inflation is still very high, and most indicators are still on the rise. So we should expect some inertia from this more stable component in the coming months. So pipeline pressures, that is the prices of those goods that typically take some time to transmit fully into consumption prices, remain at very high levels. This is certainly the case for pipeline pressures for food prices, as shown in the left panel here. All these indicators, leading indicators of inflationary pressures on food, as you can see, they are at very high levels, with little signal of reduction for the time being. And the same is true for the non-energy inflation goods on the right. Though there we see some signals, of an eventual incipient moderation in some of these pressures. In particular, those related to producer prices for intermediate goods and import prices seem to be leveling off. So let's see whether this moderation continues in the coming months. But it seems that we may be close to the peak, or we may even pass already the peak of the intensity of these pipeline pressures. But again, I mean, it will take still some time to see the full transmission of these pressures into final consumption goods. So this this slide summarizes a very interesting work being done by some colleagues at the European Central Bank, in which essentially they try to provide an answer to the question of what is the relative intensity of supply versus demand factors in driving inflation in the recent period. So without entering into many details, the main message here is that supply factors played a significant role at the beginning of the recovery phase after the COVID. And this was true for both services and in particular goods inflation. But at the same time, it is precise to recognize that demand factors are playing a role as well. And this is particularly visible in services inflation. If you look at the right chart here, the blue bars correspond to the demand component, okay? So in the case of services, it is pretty clear that over the last few quarters, again, following the reopening of these sectors after the pandemic, demand is really contributing as well to inflation in services. And it's also contributing to inflation in non-energy industrial goods, though in this case, supply factors, again, related to energy bottlenecks and so on, play a quantitatively larger role. But an important message coming from this analysis is that in spite of these very adverse supply conditions that generate these supply shocks, still it is the case that demand is playing a non-negligible role in this episode of high inflation. And this is particularly visible in the most recent period. So inflation expectations, a particularly interesting object for us when thinking about monetary policy. So I think it is fair to summarize all the information coming from the several sources, including information coming from the capital markets, through the inflation-linked swaps, and from the various surveys that we analyze periodically at the ECB. It's fair to summarize all this information by saying that it is expected that inflation will remain quite high for some time. But at the same time, different agents expect inflation to moderate in the coming, especially from the spring of 2023 onwards, in a way that by the end of the projection horizon, 24, coming from let me the main element Inflation is, as I said before, has been revised. Sorry, with the microphone, it seems to be a problem here. Yeah, it's disconnected actually. Yeah. Thank you, Fabian. So now we forecast higher inflation over the whole horizon on account of persistent adverse supply conditions. And we have revised it significantly on the upside due to a combination of some already accumulated positive surprises during the summer and somewhat higher energy prices than what we saw in June. Now, in the medium term, an important factor that explains the rather persistent core inflation has to do with wages. So we are projecting some continuation in the path of growth of wages. Okay, still at relatively contained levels, but in any case, as long as this process of wage growth has some persistence, it will show up in the inflation rates for 24, and this explains that core inflation in 24 will still lie slightly above 2%. Okay. Risks, as I said, are clearly on the downside in terms of growth and clearly on the upside in terms of inflation. So the main figures coming out of this exercise are those shown in the table at the bottom of the page. For 22, we expect a growth rate slightly above 3%. We expect a strong acceleration for 23 when in our baseline scenario, GDP growth will be below 1%. We have revised significantly the growth rate for 2023 by more than 1 percentage point with respect to our June exercise. And we have also revised downwards the growth rate for 24. Now would stand at 1.9%. Now, in terms of inflation, we have revised the figure for this year significantly. Now we expect an average inflation rate for 22 above 8%. And risk, as I said, are on the upside. Let's see what comes out in a few minutes' time. And we have revised quite significantly our inflation forecast for 23 by 2 percentage points. Now we expect an average inflation rate of 5.5% for next year. And also we see a slightly higher inflation in 24 with respect to our June exercise, so that now we expect 2.3% for inflation in the final year of our projection. So here in this picture, you can see the successive revisions that we have accomplished in the last few quarters, both in terms of the level and growth rate of GDP and on inflation. I mean, these are unusually large revisions that in a sense reflect the huge shocks that are hitting the euro area economy, the huge supply shocks that are moving inflation and GDP in opposite directions. So a word on wages. As I said before, I mean, what we are seeing is that, I mean, we rely extensively on the information coming from negotiated wages. And what we are seeing is an upward trend in the growth rate of negotiated wages. Once we clean the information from one-off components, we still see some positive trend in the growth rates of negotiated wages at the average of the euro area. Still at levels that are relatively contained, between slightly below 3% probably at this moment. But in any case, there is an upward trend there. And this, together with the new positive inflation surprises that we have accumulated over the summer, led us to revise upwards our projection for wages during the rest of the horizon. Now, on the right chart, I'm showing the average growth rates for wages all over the horizon. And as you can see there, for 2023, we are now projecting a growth rate for nominal wages, compensation per employee, to be more precise, in the vicinity of 5%. Okay, so it's a relatively high number, but still it implies, in spite of having revised upwards the nominal growth rate, this is consistent with yet another significant reduction in the real value of these wages, on the real purchasing power of these wages. In order to illustrate some of the main risk elements of risk surrounding the euro area economy. And as many of you may be familiar with this, over the last few rounds of macroeconomic projections, we have supplemented our baseline scenario with some adverse scenario that now we call a downside scenario. This is a scenario that we use in order to illustrate and communicate about the potential impact of a hypothetical situation in which several of the risk elements would materialize simultaneously. Okay. The narrative behind our latest downside scenario is one in which the conflict in Ukraine would escalate and would become more persistent, with significant adverse implications for several important commodity markets. And out of this narrative, what we have done in the context of our models is to construct a hypothetical scenario in which gas prices would be much higher than what we are seeing nowadays, which are these, this solid line is the information about gas prices coming from future markets. This was what is in the baseline scenario, okay? The dotted line is the most recent information, and as you can see here, there has been a substantial reduction in the whole path of gas prices in the spot, but also in the future markets. And the blue lines are the average for the 3 years that we have considered in constructing our downside scenario. And as you can see, we consider a significant additional deterioration in the price of gas. And the same for oil. In the downside scenario, we consider a significant and persistent increase in oil prices. Also, in building up this adverse scenario, we consider the possibility of seeing higher and more persistent prices of food. And we have also implemented some assumptions regarding some deterioration in confidence and in financing conditions. So putting together all these adverse assumptions, we arrive at a scenario in which, if all these shocks were to materialize, then we would see a significant recession in the euro area in 2023. Rather than growing at 0.9%, which is the figure for the baseline, we would see a recession of in the vicinity of minus 1 percentage point next year. And the same for inflation. Given that almost all these technical counterfactual assumptions imply a very negative supply shock, if they were to materialize, we would see inflation significantly higher than in the baseline. In particular, again, in 2023 is where this would be more visible, and we would end up with an inflation rate in the vicinity of 7%. Okay. So, this is the way in which we characterize and communicate the potential impact of the materialization of all this risk. We would have significantly lower growth and significantly higher inflation over the entire horizon, with a particularly intense incidence on 2023. So let me conclude now, just going through the main monetary policy decisions. As I said before, the policy normalization at the ECB already started in December 2021, when the Council announced the end of the net asset purchases under the pandemic emergency purchase program. The end of these purchases was implemented at the end of March this year. Later on the 1st of July, we ended the let's say regular QE program, the APP, that was initiated in 2014. On the 21st of July, the Governing Council decided the first interest rate increase by a size of 50 basis points. And at the same date, it was decided to introduce the so-called transmission protection instrument to fight unwarranted fragmentation in the transmission of our monetary policy. Now, 2 weeks ago, almost 3 weeks ago, in the last monetary policy Governing Council meeting, the decision was to rise the interest rates by 75 additional basis points. And the logic behind this significant increase in the interest rate is that it was it should be understood as a movement to front load the transition from the initial very accommodative monetary conditions to the conditions that the Council now deems necessary in order to achieve the 2% inflation target over the medium term. No? So also two important additional messages coming from the most recent Governing Council communication is that the expectation of the Council is that they will raise rates again in the next few meetings. So we are not yet where we think it is necessary to be in terms of the level of the interest rates. And importantly, and this is an important message as well, is that the Governing Council will reevaluate continuously the incoming information and the evolving inflation outlook, and all decisions will be absolutely data dependent, and they will be accomplished within the so-called meeting-by-meeting approach, okay, without pre-commitment to any particular path of policy action. So all these normalization steps are already permeating in all the indicators on financing conditions. I said before a few words about the increase in the whole spectrum of the most relevant interest rate curves. And we are already seeing that this increase in the market interest rates are already being transmitted to the real economy. First of all, in the form of some already visible increases in the cost of financing for the banks, which is the main element of the transmission of our monetary policy in the euro area. What we are already seeing is that the cost of bank financing, both in the markets through bonds and covered bonds, is clearly on the rise. Also, the cost of deposits is on the rise, yet still at very low levels. We know that. And banks are already transmitting this higher cost into the loan prices for corporates and for households. And as you can see in the right panel for the case of mortgages, and in the central panel for the case of loans to non-financial corporates. No? Something that is perhaps worth noticing is that this transmission this time is being quite uneven across the main jurisdictions of the euro area. And what we are seeing in the most recent period is that the transmission is being faster and stronger in the case of the loan rates in Germany, where the increase has been significantly higher and faster than in other large economies of the euro area like France or Spain. Good. So I will stop here, Fabian. Happy to take a few questions. Please relate it to as much related as possible to these messages and analysis.
Well, thank you very much, and very interesting, if not necessarily uplifting. And maybe I'll start with a question just on that. Maybe that's my inherent pessimism, but I was looking at all the negative risks, and I was just wondering in how far the right or wrong policy decisions will play into those risks. So how much is this dependent on, for example, fiscal policy going in the right direction, rather than some of the things we have seen trailed?
Well, that's a very good question, Fabian. I think that by and large, the main risks in the current juncture do not come from policy decisions, but come from at least not in the usual sense, no? Not from policy decisions made within the European Union or the euro area, but unfortunately come beyond our borders. I'm referring to potential further shocks in the energy markets, potential escalation of the conflict in Ukraine. So to me, these are the main sources of risk right now. No? But of course, I mean, in terms of the design of policies, domestic policies, it is always the case, no, that you can do better or worse, no. But I mean, the main dominant risk at this stage is not policy decisions made here in Brussels or in the national capitals, but unfortunately something that goes beyond our control.
Okay, I'll follow up with actually a question which was raised online, which is linked to that a bit. You were talking about external risks, and the question really is whether the recent actions in the UK add risk for the Eurozone in particular, whether there's a risk of contagion from some of the market turmoil.
I think, I mean, so far I don't see such a any clear sign of financial contagion coming from the UK. But yes, the UK is an important trade partner for the euro area, and whatever happens in the UK will have some impact on our economy, as it is a relevant partner for us. But in terms of let's say sort of financial contagion, fortunately we are not seeing any sign of contagion in the capital.
Please.
Thank you very much for that, Oscar. It's a very comprehensive and sort of very interesting overview of the challenges that we're facing right now. Just maybe building up a bit on Fabian's earlier question on what are the kind of policy decisions that are necessary. This is a very challenging time for fiscal authorities, and you highlighted the role that fiscal policy had played in cushioning the blow, but both to the people that were kind of most exposed to the impact of these shocks, but also in cushioning the blow to inflation overall. But at the same time, fiscal authorities are also thinking about the impact this will have on their fiscal sustainability going forward, which is more important for some member states than others. We've seen how, I mean, just yesterday, sort of a huge fiscal package announced in Germany to shield consumers and industry from the impacts of energy prices. So, in your view, what is the kind of best way forward, the best approaches that fiscal authorities should be taking to try and manage the impact of these shocks, which they don't have the levers on the direct source of these shocks, but they have to find some way of coping them and dealing with the trade-offs to fiscal sustainability?
Oh, well, first of all, I think it is precise to recognize that, yes, there is a space for specific fiscal measures in the current environment. Moreover, I would say that fiscal authorities are in the best possible position to tackle some of the problems that our fellow citizens are facing as a consequence of the energy crisis, because they have the best possible instruments to address these problems coming from the current crisis. Now, of course, without entering into details that go beyond my competencies, I think any kind of let's say optimal fiscal policy package directed towards cushioning the negative impact of the crisis should be temporary. I mean, the length of the packages, of the support packages, should be proportionate to the length of the situation, to the persistence of the shock. Critically, should be targeted in the sense of being really focused to those members of the economy, be it households, be it companies, that are in a more vulnerable situation in face of this energy shock. Whereas at the same time, avoiding measures that could unduly contribute to a further rise in demand pressures, in aggregate demand pressures. And preserving, whenever possible, incentives for reduction in energy consumption. And of course, with being totally mindful with respect to the need of supporting the sustainability of public finances. So yes, many conditions together, but I think this for me, this would be the set of basic conditions that should characterize any sensible fiscal package in the current juncture.
Thank you very much indeed for a very comprehensive and interesting presentation. And of course, we understand that you're not here to talk about future policies. I wanted to ask a question directly linked to something you presented. I found very interesting how you broke down the respective parts of supply and demand situations in today's inflation. And of course, you describe a potential for a significantly adverse scenario linked to gas prices. There's possibly little, at least from a monetary policy point of view, we can do about that. But you also pointed to demand side, and in particular services. Is that something you could expand a little bit on? What services, in what areas of services is it inflation price increases are being driven today, and what is then the capacity of monetary policy and timelines of acting on that?
Well, in terms, I mean, going back to your first question, no, I'm showing here again this exercise, no, of the decomposition of the relative strength of supply and demand factors in industry versus services. I mean, there are some caveats in this exercise. I mean, this is an approximation, no, based on a methodology that has some advantages, but has also some limitations, no. But taking this analysis as a good one, I mean, looking at the services, I think it's pretty clear that since the reopening of some sectors of our economy, those that were suffering more the restrictions of the pandemic, be it recreation services, accommodation services, in some cases transportation, traveling, tourism-related activities, we have seen a surge in demand. This is clear, no, and it's well captured by this methodology. I'm looking at the blue bars on the right chart here. So demand is playing a role, no doubt, in some of these services. I mean, we know that, and this goes back to your second question. No, I mean, monetary policy in this very difficult juncture can deploy its effects by dampening demand. We know that. So that's the way it works always, no? By reducing the intensity of inflationary pressures coming from demand, no? All I wanted to say here is that yes, supply factors are very important. We know that, energy and so on. This is really important, but we cannot ignore the fact that there are also in some parts of the economy there are clear signs of a strong demand. So this means that, yes, there is some space out there for effective action of monetary policy, which, as said, deploys its effects through demand, no? And also deploys effects through the signaling channel, which is absolutely essential in order to keep inflation expectations well anchored.
Thank you very much. Looking at the time, unfortunately, we are very close to being out of time. I just want to apologize to the online audience. We had an audio disruption. Sorry for that. Unfortunately, the technology doesn't always do what you want it to do. But I want to thank you very much, Oscar, for giving us these very interesting trends, the analysis behind it. I think there's a lot of food for thought, maybe a lot of food for worries, but I think ultimately it is necessary that we are very clear on the challenges we're facing, and that we're also starting to have discussions around how we can mitigate some of these effects, but also how we communicate some of this to the decision makers, but also to the wider public. In the EPC, we want to talk more about EU economic trends around what also economic policy can and has to do within that bigger picture, which we've already touched upon today. But that was a very good start for us. So thank you very much for coming. And I hope to see you again very soon at the EPC. And thank you to the audience, both in the room and online. I hope it wasn't too disruptive, but I hope to see you again also very soon. Thank you.
Thank you very much, Fabian. It was a pleasure to exchange views with all of you, and I'm more than happy to come back to sunny Brussels. Thank you.
Sometimes some sunny Brussels.